Struggling to find a reliable income stream that doesn't require constant effort and stress? Many people feel overwhelmed by the complexity of investments in the stock market. The good news is there's a solution that might be simpler than you think: ETFs. In this video, I'll show you the fastest way you can live off ETFs. I'll show you the problems with dividend investing, which often requires over $100,000 to generate a reasonable monthly income. I'll show you the fastest strategy to live off dividends for people in their 50s, those in their mid-30s, and young individuals. In the end, I'll show you how much each of these age groups needs to invest to retire with $1 million portfolio that takes care of their monthly expenses. But first, what exactly are ETFs? Simply put, an ETF is a collection of securities like stocks or bonds that you can buy and sell on a stock exchange, much like regular stocks. This means you get the diversification of a mutual fund with the flexibility of trading individual stocks. There are several types of ETFs, each serving different investment goals. Stock ETFs, for example, track a particular index like the S&P 500, offering you a slice of the entire market. Bond ETFs, on the other hand, focus on fixed income securities, providing stability and steady income. Then there are sector and industry ETFs that zero in on specific areas of the economy, like technology or healthcare, allowing you to target your investments more precisely. One of the biggest benefits of ETFs is diversification. By spreading your investment across a broad range of assets, you reduce the risk associated with investing in single stocks. Now let's get into why ETFs are such a game changer for generating income. They often come with dividends, which can be a reliable income source. Moreover, with the right strategy, ETFs can grow your capital while providing regular payouts. This combination makes them a powerful tool in your financial arsenal, whether you're looking to build wealth or secure a steady income stream. So let's get real. Living off dividends sounds amazing, but it's not as straightforward as it seems. While the math can look promising, the reality of accumulating enough capital to generate substantial income through dividends can be daunting. Let's dive into the numbers and see what this really looks like for most people. First, let's take a look at some net worth statistics to set the stage. In the United States, the median net worth for people under 35 is just $39,000. Even as people age and ideally accumulate more wealth, the numbers still pose significant challenges. For example, the median net worth for those aged 45 to 54 is around $247,200. While this is a considerable amount, it's still below the $1 million needed to generate $40,000 annually at a 4% dividend yield. The fact is, most people aren't close to having the required investment capital to live comfortably off dividends. This gap between average net worth and the necessary capital to generate a significant dividend income highlights the challenges that so many of us face. High-yield stocks and ETFs can be tempting, but they come with their own set of risks. Companies that offer high dividend yields might be doing so because their stock prices have dropped significantly due to underlying issues. This means you could be exposed to greater risks, including potential capital losses. Additionally, during economic downturns, companies might cut dividends to preserve cash, directly impacting your income stream. Diversification is crucial to managing these risks. Instead of relying solely on high dividend-yielding stocks, consider building a balanced portfolio that includes both dividend and growth-oriented ETFs. This can help spread the risk and ensure that your income isn't overly dependent on a few high-yield investments. In the end, I'll show you the lowest amount these age groups need to invest in order to retire with $1 million portfolio that takes care of their monthly expenses. When selecting ETFs, it's important to consider several factors to ensure you're making sound investment decisions. The expense ratio is certainly a key factor. This annual fee is charged by all funds or ETFs as a percentage of the fund's average assets under management. Performance is another crucial factor. While past performance doesn't guarantee future results, it can give you an idea of how the ETF has managed through different market conditions. Look for consistent performance over the last 5 years. Understanding the risk profile of the ETF is also essential. Stock ETFs can be more volatile compared to bond ETFs, and sector and industry ETFs might carry higher risks due to their focus on specific areas of the economy. Ensure the ETFs you choose align with your risk tolerance and investment goals. A well-balanced portfolio includes a mix of different types of ETFs to optimize growth while managing risk. Stock ETFs, which track indices like the S&P 500 or specific sectors such as technology or healthcare, offer the potential for growth and are ideal for long-term investments. Sector and industry ETFs allow you to invest in specific sectors or industries, such as technology, healthcare, or energy, targeting growth in particular areas of the economy, but they can be more volatile. Based on these criteria, I've selected the following ETFs for my portfolio, and here are their current dividend yields, dividend growth rates, and average share price appreciation. Noble, VGT, XMHQ, FXO, and SCHD. Noble focuses on companies within the S&P 500 that have consistently increased their dividends for at least 25 years. This ETF provides a stable income stream through dividends and includes high-quality companies known for financial stability. VGT invests in technology companies, including giants like Apple, Microsoft, and Alphabet. This ETF is aimed at capital appreciation through exposure to the tech sector, which has strong growth prospects. XMHQ focuses on mid-cap companies within the S&P 500 index that exhibit strong quality characteristics such as high return on equity and low financial leverage. This ETF helps diversify the portfolio by adding mid-cap exposure. FXO provides exposure to the financial sector, investing in a mix of large and mid-cap financial stocks. This ETF is designed to enhance the returns by selecting stocks based on growth and value factors. And finally, SCHD focuses on U.S. stocks that have a high dividend yield and strong financial health. This ETF is known for its low expense ratio and high dividend yield, providing a steady income stream. By combining these ETFs, the portfolio achieves a balance of income, growth, and diversification. Noble and SCHD focus on dividend income and stability. VGT provides high growth potential. XMHQ adds mid-cap diversification, and FXO offers sector-specific exposure with additional income potential. This balanced approach ensures a resilient and well-rounded portfolio capable of weathering various market conditions while aiming for both income and capital appreciation. Remember, in the end, I'll show you how a portfolio of these ETFs can help each age group retire with a portfolio close to $1 million and cover their monthly expenses. So back to the portfolio. This portfolio of ETFs will have a current dividend yield of 2.76%, portfolio dividend growth rate of 16.81%, and average share price appreciation of 10.74%. Now, planning for retirement isn't a one-size-fits-all scenario. Depending on when you plan to retire, your income needs, lifestyle expectations, and the amount you need to save can vary significantly. Understanding these differences can help you set realistic and personalized financial goals. For those who are on the older side of the age group, we'll call you more experienced, aiming to retire within the next 10 years, the focus is on aggressive saving and investment. A comfortable retirement might mean living off around $3,000 per month. If you're planning to retire in 20 years, your financial goals will need to account for inflation and potential lifestyle changes. As expenses rise, you might find that $3,000 a month isn't enough. Instead, you might aim for around $6,000 per month to ensure a comfortable and flexible lifestyle. For those with a 30-year horizon, the landscape changes even more. You'll need to account for a longer retirement period and higher inflation rates. Aiming for $10,000 per month can provide a very comfortable lifestyle covering all basic needs, luxury expenses, and unforeseen costs like healthcare. All right, now that we've set the stage, let's dive in and talk about how much you need to invest to live off dividends comfortably, no matter your age. I'm breaking it down into 3 scenarios: those nearing retirement, those in mid-career, and young folks just starting out. Each plan has a different investment timeline and contribution strategy to show you how you can grow your money and eventually live off those sweet, sweet dividends. For those of you looking to retire in the next decade, here's the deal. Start with an investment of $50,000 and contribute $3,000 every month. After the first year, your investment would grow to about $92,760. By the 5-year mark, you'd have around $333,949, and in 10 years, you'd be sitting on $913,768. At retirement, this would give you an annual dividend income of $35,791, or about $2,983 a month. It's a solid plan if you can save aggressively and want to ensure a stable income stream soon. Now, if you're in your mid-career with a bit more time to grow your investments, start with $20,000 and add $500 each month. After 1 year, you'd have approximately $28,704. Fast forward to 5 years, and that's $78,000. 10 years in, you'd be looking at $197,132, and by 20 years, you'd have $1,116,707. This would generate a nice annual dividend income of $79,055, or $6,588 monthly. This approach gives you the benefit of time and compounding interest, which significantly boosts your retirement income. For the younger crowd with a longer horizon, you don't need any initial investment. You can simply start with just $1,200 monthly contributions. That's roughly $25 per week. After 1 year, your investment stays at $1,200, but stick with it, and by 5 years, you'd have around $7,940. After 10 years, that's $24,054. In 20 years, you'd be at $147,218. And in 30 years, you'd have a nice balance of $1,170,164. This would provide an annual dividend income of $141,882, or about $11,823 monthly. And that is the power of starting early. All of this shows that by starting early, even a small initial investment can grow significantly. The $25 per week grows exponentially as the reinvestment compounds year after year, leading to substantial growth. This strategy leverages time, making it a powerful tool for young investors aiming for long-term financial independence through dividends. Want to know a step-by-step guide on how to make a portfolio that pays over $30,000 in monthly dividends? Click the video on the screen to find out.